Diversification is a cornerstone of prudent investing. It involves spreading investments across various assets to minimize risk. The basic idea is simple: don't put all your eggs in one basket. By holding different types of investments, you can protect your portfolio from the volatility of any single asset. This strategy helps balance the risks and returns within your investment portfolio. Investors often strive to achieve diversification by including a mix of stocks, bonds, real estate, and other assets. The goal is to create a portfolio that can withstand market fluctuations. Diversification works because different assets react differently to market conditions. When one asset class is down, another might be up, thus balancing the overall performance. However, diversification must be done thoughtfully. While it can protect against risk, it can also lead to complexity if not managed well. Investors need to understand how to diversify effectively without overcomplicating their portfolios. This ensures that they achieve the desired balance of risk and return. A well-diversified portfolio does not mean owning a random assortment of assets. Instead, it should reflect a strategic allocation that aligns with the investor's financial goals and risk tolerance. Proper diversification requires careful selection and ongoing management to ensure the portfolio remains effective over time. Over-diversification occurs when an investor spreads their investments too thinly across too many assets. This can dilute potential returns. Instead of enhancing performance, it can lead to mediocre results. Gains from well-performing assets are offset by others. The impact can be significant. Portfolios may not generate expected returns, especially if additional assets don't reduce risk. The portfolio becomes too complex to manage. Over-diversification often results from lack of strategic planning. Investors may add more investments to cover all bases. This can lead to overlapping investments. Instead of maximizing returns, they end up with an inefficient portfolio. To avoid pitfalls, focus on a balanced portfolio. Select investments that contribute to overall goals. A streamlined approach can lead to better management and higher returns. Several factors contribute to over-diversification in investment portfolios. One common cause is the misunderstanding of risk. Investors often believe that by diversifying broadly, they are minimizing their risk significantly. However, this can lead to a dilution of potential returns without truly reducing risk. Fear of loss is another driver of over-diversification. Investors naturally want to protect their capital. In doing so, they may spread investments too thinly across numerous assets. This fear-based approach can lead to a convoluted portfolio that is challenging to manage effectively. A lack of a clear investment strategy also contributes to over-diversification. Without a defined plan, investors may add assets haphazardly. This can result in a portfolio that lacks focus and direction. Moreover, following market hype without a clear strategy can further exacerbate the problem. Lastly, market trends and external influences often lead investors to over-diversify. In an attempt to capitalize on every opportunity, they may end up with a portfolio that is too complex. This highlights the importance of having a well-defined investment strategy that guides decision-making. Investors often make common mistakes that lead to over-diversification. One such mistake is owning too many similar funds. When an investor holds multiple funds with similar strategies, it can create unnecessary overlap. This reduces the potential for higher returns and makes the portfolio harder to manage. Another mistake is the overuse of multi-manager products. These products can result in overlapping investments that provide no additional benefit. Investors may believe they are getting diversified expertise, but they might end up with a redundant portfolio instead. This can dilute returns and add complexity. Investing in assets that one does not understand is also a common pitfall. In the pursuit of diversification, investors may add unfamiliar assets. This can lead to poor decision-making and ineffective portfolio management. It is crucial to understand each investment's role within the portfolio. Lastly, the lack of a clear strategy is a significant mistake. Without a focused plan, diversification efforts can become random. This leads to a portfolio that lacks coherence and fails to achieve its intended objectives. A strategic approach is necessary to ensure that diversification enhances rather than detracts from portfolio performance. Section 5: Practical tips to avoid over-diversification. One of the key strategies to avoid over-diversification is focusing on quality over quantity. Instead of adding numerous assets, investors should carefully assess each investment. They should consider how each asset contributes to overall goals rather than simply increasing the number of holdings. Avoiding unnecessary complexity is also crucial. A complex portfolio can be difficult to manage. It may not provide additional benefits, leading to inefficiencies. Simplifying the portfolio by reducing overlapping investments can enhance performance and ease management. Regular portfolio review is another practical tip. By assessing the performance of each asset regularly, investors can identify overlaps and consolidate holdings. This ensures that the portfolio remains aligned with financial goals and market conditions. Regular reviews also help in making informed investment decisions. Finally, seeking professional advice can be invaluable. Financial advisors can provide personalized guidance tailored to individual goals and risk tolerance. They help in crafting a strategy that balances diversification with concentration, ensuring the portfolio is both effective and manageable. Section 6. Managing portfolio size and industry diversification. Keeping a manageable portfolio size is essential for effective investment management. Investors should focus on their highest conviction investments. This involves concentrating on assets with the greatest potential for returns, rather than spreading investments too thinly across many holdings. Industry diversification is also important. By spreading investments across various industries, investors can mitigate sector-specific risks. This helps protect the portfolio against downturns in any single sector. However, it is important to ensure that this diversification does not lead to unnecessary complexity. Trimming unnecessary holdings is a practical step to maintain a streamlined portfolio. Investors should reduce investments held solely for diversification, especially if they're volatile or difficult to understand. This helps in focusing on quality investments that align with long-term goals. Managing portfolio size and ensuring industry diversification requires careful planning. Investors should regularly monitor their portfolios and make adjustments as needed. This ensures that the portfolio remains aligned with financial goals and market conditions. Section 7. Balancing diversification with concentration. Balancing diversification with concentration is key to a successful investment strategy. Investors should examine the underlying investments in their funds to identify potential overlap. Analyzing holdings helps in streamlining the portfolio and eliminating redundancies. Streamlining ETFs is another effective tactic. Investors should focus on a smaller selection of ETFs that provide adequate diversification. This helps avoid unnecessary duplication and simplifies portfolio management. A focused approach can enhance returns while maintaining diversification. Considering fee implications is also important. Holding too many investments can lead to higher expense ratios and trading fees. These costs can eat into returns, reducing the overall effectiveness of the portfolio. A balanced approach helps in minimizing costs and maximizing returns. Ultimately, achieving a balance between diversification and concentration requires a strategic approach. Investors should focus on owning enough investments to mitigate risk while concentrating on prime opportunities. This ensures that the portfolio remains both diversified and focused. Section 8. Importance of regular reviews and professional advice. Regular reviews of your investment portfolio are crucial. They help in assessing the performance of each asset and ensuring alignment with financial goals. Reviews also enable investors to make informed decisions about consolidating overlapping holdings. This keeps the portfolio streamlined and efficient. Seeking professional advice is equally important. Financial advisors offer expert guidance tailored to individual needs and risk tolerance. They provide insights into market conditions and help craft strategies that balance diversification with concentration. Professional advice ensures that the portfolio remains effective over time. Regular reviews and professional advice work hand in hand. Together, they help investors maintain a balanced and effective portfolio. By periodically evaluating investments and seeking expert guidance, investors can adjust their strategies to align with evolving goals and market conditions. Ultimately, these practices contribute to the long-term success of an investment portfolio. By staying informed and proactive, investors can achieve their financial objectives while avoiding the pitfalls of over-diversification. This leads to better decision-making and enhanced portfolio performance. Section 9. Conclusion. Achieving a balanced investment portfolio. Avoiding over-diversification is essential for maintaining a balanced investment portfolio. By focusing on quality over quantity, investors can enhance returns and manage risk effectively. A strategic approach to diversification ensures that the portfolio remains aligned with financial goals. Maintaining a clear strategy and regularly reviewing the portfolio are key practices. These help in identifying overlaps and making necessary adjustments. Seeking professional advice further enhances portfolio management by providing expert insights and guidance. In conclusion, achieving a balanced investment portfolio requires careful planning and ongoing management. By following the tips outlined in this essay, investors can avoid over-diversification and concentrate on quality investments. This leads to a more efficient and effective portfolio that supports long-term financial success. Ultimately, the goal is to achieve a diversification level that mitigates risk while maximizing returns. By focusing on strategic investment choices and regular reviews, investors can create a portfolio that meets their financial objectives and adapts to changing market conditions.